All right, so part 3 of our series on how you calculate taxes in retirement. Now, unfortunately, the husband just died. So we have a widowed woman here, and we're going to talk about how much more she will pay in taxes on less income. It's horrific when it comes to tax code. No one seems to care except for me. So I will say this like I'm Paul Revere. We're going, the British are coming, the British are coming. The tax man is coming for you widows in particular, or widowers, it doesn't matter. It's gender neutral, but just the fact that most men die and leave a surviving spouse as a woman. We're going to talk about that here today. All right, so the first thing we got to figure out, here's my pen, is our provisional income. As I always talk about, we got to figure out provisional income, which tells us how much of our Social Security benefit is subject to taxation. All right, so first thing, remember, before when they're married, filing jointly, that's what MFJ stands for, they had $30,000 of Social Security, $15,000 of IRA, and $10,000 of tax-exempt interest, all right? Now, the husband died. We'll say the husband had $20,000 of that Social Security amount, and the wife had $10,000. So just say for me, my wife and I have $20,000 of Social Security income. She has $10,000, so between us, we have $30,000, but at my death, she will lose her own and she will capture mine instead. So now she has $20,000 of Social Security income, still has the same IRA distributions because the same required minimum distributions are applicable to her because we're the same age. So that doesn't change. The only thing that changes from her income perspective is she loses her own Social Security. So she loses $10,000. And of course, she still has her $10,000 of tax-exempt interest. So her total income is $45,000, which is $10,000 less than what we had together as a married filing joint couple. So provisional income. So provisional. And remember, friends, you can't go to the tax code and to see what the provisional income rules are. It doesn't say that. I think the Social Security, it says combined income is a term you might want to use, combined income. The reason us in financial planning use the term provisional income because there's a provision in the Reagan tax bill of 1983 that subjected some Social Security to taxation. And then there's a provision in the Clinton tax bill in 1993 that subjected some Social Security taxation as well. The irony of it all is that the provisions weren't indexed for inflation. We're not. So we're still operating on the same numbers for income as it was in 1983, which is sickening. All right, so provisional income. What we have to do is we got to figure out what Miss Smith's provisional income is. So we take half of Social Security, which in this case is $10,000. We add IRA, which in this case is $15,000. And then we have tax-exempt interest. Now, I use my joke that I've used twice now, and I'd like for you guys to laugh with me, if you will. But Josh, tax-exempt interest is not subject to income tax. It's true. Tax-exempt interest is not subject to income tax, but it's certainly part of the calculation to figure out how much of your Social Security is taxed. Trust me, it is. In this case, 10 plus 10 is 20, plus 15 is $35,000 is his or her provisional income. $35,000. Now, what we do is we take 0 to 25. That is not subject to income tax whatsoever. Not subject to income tax whatsoever. 25 to 34. Half of that is subject to income tax, and anything above 34, nothing is subject to income tax whatsoever. So here we got $35,000. The first $25,000 is free of any taxation. The next, in this case, $9,000, half of that is subject to tax. All right, so half of that right there is subject to tax. Now we have anything above $34,000, which is $1,000. 85% of that is subject to tax. Oops, I should put 85% there. Let me just erase that. 85% of the third provision, this is called the third provision, is subject to tax, which is $850. So how much of our Social Security is taxed? Let's take a look at my trusty calculator. And I take my little TI, and I say $4,500 plus $850. $5,350, my friends, is subject to taxation. 5350. Whoop. That's how much of our Social Security is subject to taxation. 5350. So let's go ahead and erase all this. And the irony of it all, I'll share with you. Joops, joops, joops. All right, let me show you what I'm talking about. 5350. You want to see the irony of it all? So look, before their taxable Social Security is $4,000 when they had $55,000 of income. Now their taxable Social Security, her taxable Social Security is $5,350. 10,000 more of income, $1,350 less of taxable Social Security. Oh, but I don't need to worry about the widow's tax. Yes, you do. And that could be a man talking like that, by the way. All right, so now we got to figure out what our AGI is. Adjusted gross income. We got to figure out our AGI. So now what we do is we take our taxable Social Security, 5,350, and we add to that our IRA distributions, 15,000. We add them up. That's 20,350 is our AGI. 20,350. All right. Now we don't, in this case, we do not use our tax exempt interest because tax exempt interest is not subject to income tax. All right. So now she's a widow, so she has a $13,600 standard deduction. Now I can't figure that in my head, so I take my trusty calculator again. And I say, okay, 20,350 minus 13,600. $6,750 is her taxable income. That will all be subject to 10%. All right, so taxable income is $6,750. Which means she'll pay $675 in taxes. Anything jump out at you here, my friends? You want me to point out? Before, they had $55,000 of income. They had nothing for taxable income. They had negative $7,600 of taxable income. Now she has $45,000 of taxes, and she has $675 of taxable income, of income tax. So her taxable income has increased by $6,750 plus $7,600. Her taxable income has increased by $14,350 because now she has a positive taxable income $6,750. Before she had a negative taxable income $7,600 when she was married finally jointly. Before she had no taxes due. Now she has $675 of taxes due. Before she had $55,000 she could spend. Now she's got $45,000 she can spend. So she has, we take $10,000 divided by 55. She has 18%, almost 18.2% less income, and yet she has, I don't even know how to calculate that. 13,000. She has 13,000 more of taxable income. 18% less income, 13,000 more of taxable income. She had no taxes before, and now she has $675 of taxes simply because she's no longer a married filing jointly unit. Don't tell me about the marriage penalty. This is a widow's tax trap like you wouldn't believe. And it's only going to get worse, which I show you in the next video. That is what happens right there. Show me differently. I'm telling you, I know there are a lot of people out there that say that doesn't make sense. You're right, it doesn't make sense. It's the insanity of the tax code. I'd love for you to show me how this works differently because you won't be able to. But I challenge you to do so, for sure. As always, if you like what you see here, don't forget to subscribe down below. I'd love to hear comments, questions, concerns, anything on your mind. Let me know. I'd love to hear it. And don't forget to go to the blog at heritagewealthplanning.com. Stay tuned for part 4 of this, where I show you what happens when we do a Roth conversion. Remember, we did a Roth conversion over here, and the Roth conversion increased a $10,000 Roth conversion, increased their taxable income by $17,100. Watch what happens when we do a Roth conversion for a widow as well. It's not going to be pretty. And then finally, we'll do the case study I was talking about today with a lady, and that'll be our last of the I guess that'll be 5 episodes. We'll see you next time. Thanks.